And we are recording. Hello, hello. It's Donnie. It's your boy, and this is the What's Up with Real Estate in Toronto podcast with my girl Raki today.
Hello.
Raki from Mortgage Savvy. If you're watching, you see her on the screen. Let me just make sure that I do that there. And if you're listening, well, she's there. Believe me.
Yeah.
So I'm once again in my attic, which is surprisingly amazing for audio, Raki. I gotta tell you.
That's
Like
great.
there's not a lot of bounce of sound and stuff, which is pretty good. Get the headphone in and you're good to go. So Rax, hi.
Hi, how are you?
We're doing okay. We're surviving mostly. Uh, there's two kids in the house right now. They're both still wearing pajamas, and this is being recorded midday
hmm
on a Friday. So, which explains why I'm still in a sweatshirt as well, because it is what it is at this point.
We're getting used to our new reality.
That's right. Um, Yesterday I had a meeting and I actually put on a dress shirt and I had track pants on because
I know, just
who
getting
cares? Who cares? Yeah. So it worked. Okay. Raki, the reason why I invited you onto this is Raki's a mortgage broker. She owns Mortgage Savvy, which is her own brokerage, few mortgage agents along with Raki, and they help people like us um, finance home purchases. So investment properties, your own home, whatever. And so I wanted to take this session down that path. I wanted to go the mortgage route and ask a few questions about what's happening out there right now. And I have some specific questions that I want to bring up with you as well. Very generally, though, I want to start and give everybody sort of a baseline understanding of what a mortgage is. Generally, there are two types of mortgages: fixed rate and variable rate. So Rax, can you explain the differences? Like I'm a 5-year-old, explain it to me at that level: fixed rate versus a variable rate, and those are two categories of mortgages.
For sure. So a mortgage loan is a loan that a bank or lender will extend to help you purchase property. Now, when you are confirming your mortgage loan, you have the option of selecting either a variable rate or a fixed rate product. With a fixed rate mortgage, your rate will remain the same for the term of the mortgage. Now, usually what we have clients do is sign in for a 5-year term. We usually find that lenders will offer the best or the lowest rates on the 5-year terms because they're looking to secure your business for that 5-year term. So with a fixed rate, your payments don't change and there's that consistency and predictability of where your payments are going to sit and what your interest rate will be. So that is usually a really good fit for a first-time home buyer or a client that's just looking for predictability and stability over the next 5 years. With a variable interest mortgage, your interest rate will go up and down based on where the Bank of Canada has the prime rate sitting. So if the Bank of Canada were to increase interest rates, you could potentially see an increase in your payment obligations because your rate would increase. So I'll give you a really simple example.
Sure.
Currently, the prime rate is sitting at 2.45. Now, historically, when a lender is offering a client a variable rate product, it's usually explained as a discount. So it's usually prime plus or minus a discount. So most clients are sitting with a discount of approximately, depending on their own contracts. Right now, we're doing prime minus, for example, 20 or 25. 2.45.
So if prime's at 2.5, for example, and you had a prime minus 20, that means 2.5 minus 0.20 is 2.3.
Correct. And that would be interest rate. Yeah. However, that would change with the Bank of Canada's sort of rates. So it doesn't give you as much stability, but historically what we have found is that the variable rates usually allow clients to pay less interest over the term of their mortgage.
Okay. So there's reasons why one would want a fixed rate and there's reasons why one would want a variable rate when you're deciding at that mortgage, because you have two paths here, guys. You got to choose one or the other when you're making a decision to borrow money. So basically, it's how are you going to pay it back? What kind of terms you want to pay it back on? Is it going to be a fixed rate where you know for a fact this is the rate forever? and variable is it changes when the Bank of Canada announces changes to their rate, call it that, to keep things really simple. So the reason why I specifically wanted you to be on this meeting with me is you used to work at the banks.
Correct.
And the way, so here's what happens. Me, Joe Blow, I've got savings accounts at my bank, and I lend the money essentially to the bank. So it's in my savings account, and in exchange, the bank pays me a very low interest amount, but they pay me something. So I understand they're going to be using my money for something else. In exchange, they're giving me money on interest. What they're doing is they're taking our deposits and they're lending it out for other people for mortgages and stuff. Okay. So as long as you understand that's the basic premise of how the banks are getting funds and all that kind of stuff, I want to talk about how this applies to fixed rate and variable rate stuff. All right. On the fixed rate market, where are lenders, banks getting money to lend out for mortgages from? Where are they getting that money?
Lenders will usually source their funds to fund these mortgages from their deposits. So that's your income coming into your savings or your checking account every time you're being paid.
Okay.
What about you making your mortgage payments as well?
Yeah.
Those deposits going into your bank account.
I'm thinking more along the lines of the bond market, right? Like, so there's the market where if I wanted to, as an so now this is not me, the guy who's giving money in the banks for savings. This is me now as an investor. I want a pretty secure investment. I'm going to agree to lend money to the bank. Okay, and the bank's going to give me a bond. So we're going to make an agreement that I'm going to lend them money. So I'm going to give them my money. It's not savings now, and now I'm lending it out, and in exchange for an interest rate. And this happens across the board. Like it's a pretty big market. Certainty of all this. So the banks agree to pay me back 2% in exchange for all my money. The banks are taking the money that they're borrowing at 2% and they're lending it out. If they signed a deal with me that says I'm lending it to them for 3 years, they're going to go and take that 3-year money and they're going to lend it to somebody else who's got a 3-year term, for example, on a mortgage, and they're going to lend it out at a higher rate than that. And there's obviously doing some credit risk and analysis and research and all that stuff, and they have overhead, all that stuff built into this, but they're making money on borrowing from me and lending it to somebody else because I don't know that person that needs those funds.
Correct.
Okay, so basically, like high level is where I'm going with this on that one. So that's how I see, and thank you for confirming that. That's how I see the fixed rate market where the money's coming from. Okay, so when the Bank of Canada has this rate that we keep hearing about, the prime rate or overnight lending rate or whatever we want to call the underlying number, it's got nothing to do with rates on the fixed rate side because that's a completely different market.
Correct.
Right. Okay. On the variable side, then, the Bank of Canada, so the federal government decides. This is a liquidity thing that they have a number in mind. Why don't you explain what the overnight lending rate means and how it's a basis for all this stuff? How about that?
So currently the overnight lending rate is sitting at 0.25. And what we've seen is the prime lending rate go from, right now it's sitting at 2.45. So we saw 3 decreases to the overnight lending rate.
Sorry, Max. So you're absolutely right. I think you're a step ahead of me. What I'm thinking of is just like how are rates even decided? Like, what are the implications? So Bank of Canada decides, they call this thing an overnight lending rate. What does the overnight lending rate mean? Who does it apply to? That kind of stuff. And then we'll talk about rates specifically. Is that okay?
Sure, absolutely. So in terms of, the overnight lending rate impacts, obviously, the cost of borrowing, basically. It reduces the cost of borrowing, which allows, especially when there's instability in a market, by reducing the overnight lending rate, you're lowering the cost of borrowing funds. And that usually happens when the Bank of Canada and the federal government is looking to provide some additional stability and stimulus in the economy.
Okay, but even one level lower than that, so the banks, CIBC, TD, lenders,
Mhm.
lenders could borrow money from the government
Correct. So it
at
reduces
this.
cost to
Yeah.
borrow,
So
allows them to generate additional profits as well.
okay, but just like at the root level, if the bank needs money,
Mhm.
the bank, not the Bank of Canada, the actual banks. If the banks need money, the banks can borrow from the Bank of Canada at the overnight lending rate,
Correct.
and that rate goes up and down with policy and with changes in the market, all that kind of stuff.
For sure.
And so the banks take this money from. So let's just say the banks are borrowing $100 million from the Bank of Canada at its overnight lending rate. The banks can do that. They have access to that system, and they in turn they could place that money amongst mortgages and that kind of stuff. And then so they have a rate. The banks have a rate that they lend out to that is based on the overnight lending rate. So as it goes up, the bank's rate that they're lending out money to us goes up. And as it goes down, it follows suit as well. And it sort of works in that pattern, up and down. So it's got nothing to do with the bond market we talked about a second ago. It's got everything to do with this key rate at the government, this overnight lending rate. Based on that, banks have a prime rate. Based on that, that's how much they're lending. That's how much money we're paying as borrowers to borrow that money.
Correct.
So as it goes up and down, so do our rates go up and down as well. So we're not tied to a specific number for a period of time. We're just giving the banks the profit between what they're borrowing at and what they're lending to us at. So the ways the bank makes money are different under each scenario.
Correct.
But both of them are based on spreads, correct?
For sure.
Okay.
For sure. For example, with the prime rate having fallen, if you were in a variable rate product, you immediately saw your interest rates decrease. So you immediately benefited from a lower mortgage payment and a lower interest rate.
But the banks cut on that wouldn't have changed at all because they're still borrowing from the Bank of Canada and
Right.
lending it out to us. So if their spread was 2%, it's still 2% regardless of a decrease or increase. They're still making 2%. That stays the same, right? Okay, so my question now is COVID-19 comes in, and in a time when we saw both fixed rate, well, the variable rate didn't drop as much, but the fixed rate definitely the fixed rate products were definitely coming down
Mhm.
over the last year,
Mhm.
and the variable rates didn't really move. I think they might have came down a quarter or something. I don't know, but not really substantial moves. But I remember looking around a little while ago, and a 3-year term, a 3-year fixed rate mortgage was above 3, and then pre-COVID, you can get them at like 2.5, 2.6, for example.
Correct.
Okay, so now and COVID comes in, people are still buying houses. People are buying houses and they're trying to secure mortgages. And lo and behold, even though the bond market hasn't changed, like the offerings on the bond market, from what I understand, this is where I need your help. They haven't changed, but the rates have gone up. The rates that banks are offering borrowers have gone up. Is that true?
So the fixed rates have increased, and that's strictly a result of, so when the Bank of Canada reduced the overnight lending rate, and you're correct, the banks are still profiting. It's important to remember that the banks don't work for the Bank of Canada, they work for their shareholders, right? So
Yes,
it's important
yes.
to keep that in mind.
Yeah.
Two, with the mortgage deferral program that was being offered, the impact of that is not on the Bank of Canada. The impact of that is on the banks having these mortgages on their books that are now no longer being paid. So for example, if you have a client that isn't paying their mortgage and that mortgage is now being deferred, that interest, although it's not free money, it is being, added to the principal amount being owed, but there is still that is causing liquidity pressure. Now, if they have a client that has a GIC for, let's say, $100,000 that they've committed to paying that interest rate on, they can't go back to that client and say, oh, because so-and-so isn't paying their mortgage, we're having less deposits, so now we're not able to meet our commitment on paying you that return. So what the Bank of Canada in essence did is they asked the banks to keep these mortgages on their books without having to necessarily feel the financial impact. They were hoping to help sort of cushion that that sort of impact by
Okay.
reducing the overnight lending rate, increasing their profitability so that they could start absorbing some of the costs associated with these mortgage deferrals, which is why as mortgage brokers or effective mortgage brokers, it's our job to ensure that we're communicating to our clients that the deferral program isn't necessarily a blanket offering to all, but really a mechanism to provide support to those that truly need this
Okay.
as an option to be able to continue to meet their financial obligations.
So the way I look at the way I saw this, okay, and I'm specifically talking about fixed rate now. Okay,
Mm-hmm.
so this chat started with one and the other. We're talking about fixed rates here,
Mm-hmm.
and the way I saw this, it looked to me like there. Thank you for making me aware of that. It didn't look like there was a lot of added risk on the bank side. Instead, what they did was just raise rates because they could point to something and say there is added uncertainty in our markets. There is added risk. Therefore, I will be taking a higher split going forward from mortgages. Having heard what you just said, I still think that part of that is still true. I think there's definitely some profits being there, but they're also trying to make up for the shortfall on their obligations because of all these deferrals. So this 3 or 4 months of deferrals, whatever it will be, 6 months, whatever it's going to be, they're going to be just fine on the back end of this. They're going to have oodles of dollars coming in, those years away from now. But right now, there is a bit of a tightening on access to money to pay out to their shareholders and all that stuff.
Absolutely.
Okay. So how do you feel about, not to put you on the spot, and if you don't want to answer, you can abstain. How do you feel about is there a profit taking happening right now on the fixed rate products by lenders?
There absolutely is. So there's absolutely that profit component, but I do think that we are navigating unprecedented times. And I think for the moment it was required, right, to help ensure that we're cushioned and we're in a position to be able to sustain. I think we're fortunate to be in a country where federal regulation and OSFI puts pressure on our big banks to maintain a certain level of liquidity as well. So that is reassuring to me as well. So I do think that the higher fixed rates were part of the reaction to the current pandemic and situation. We are starting to see a little bit more stability. So fixed rates did start to slightly decline this week. So those that have been paying attention to rates, we have started to see, as I think we're all getting comfortable with our sort of new norm of quarantine and being at home. But I also feel that there's been a little bit additional stability as well, especially with the Bank of Canada committing to buying bonds. There is that little bit of additional sort of stability happening, and we are starting to see the fixed rates decrease. And my prediction is that as we start to see things continue to stabilize, that those savings will eventually be passed on to the consumers and to our buyers that are looking to secure mortgages.
I think so savings being passed on, but it's also the savings that was there, and now they took them back, and now they're giving them back to the client. So
Correct.
Less profit taking. On the variable side, so switching gears on the variable side. So, if I had a prime minus something mortgage before, and like say, normally you would find prime minus 1%, prime minus 0.5%. Those are pretty normal mortgages to have, I would say, in the last 5 years. And now you're lucky if you can get prime minus 10.10.
Correct.
Like so how that spread, I can't, maybe it falls into adding some more deposit or some more cash liquidity into the banking system, but other than that sounds like a straight profit take, because all they're doing is taking 2% before. Now they're taking 3% off of our loans.
Correct. So they have, decreased. So fixed rates increased to help profitability and to help create that cushion. And with the variable rate products, the reaction was to reduce the discounts. And for the first time in years, we started to see variable rate offerings being expressed as a premium as well. So we started to see prime plus as well.
Yeesh. My goodness. Okay. Anyhow, I came into this with a bias for sure, thinking this is straight profit taking and taking advantage And it still might be, but I think that you've eased a little bit of my concerns saying, yeah, but they got to meet their debt obligations as well to people in the GIC and bond market who they're borrowing from. Like they promised they would pay, and they've got to pay. And so this is how they've decided to find ways of getting new money.
And I'm
Um,
not shying away from the fact that in the end of the day, the banks work for their shareholders, so they need to ensure profitability.
yeah, but the bank stocks have like got absolutely slaughtered, and the mortgage business is a huge part of their business.
Mhm.
So if if there's little impact on the mortgage because they're still meeting obligations and they're going to have some added interest at the end of this whole thing, they might even come out ahead in that side of the business when the dust all settles. So anyway, it's a buying opportunity for sure on bank stocks if you're in the market. I feel like they're going to be just fine through all this, despite like the forced deferred program and all that kind of stuff that was on them. Anyhow, interesting times, and I'm so curious to find out what happens in the next little while, for sure.
For sure. I think the timeline is uncertain for all. We're all wondering as to when that stability will fall into place.
Yeah,
Uh, these are unprecedented and uncharted waters. So all we can do is try to stay as current as we can and try to understand, the various sort of perspectives to this as well. But we are finding that we do have some really aggressive rate specials. So on a 3-year high ratio mortgage, we can do a fixed rate of 2.49. So
oh,
these rate specials still exist. They are offered on rate specials contingent on a specific closing date. So if you're closing in the next 60 days, you are likely to secure a lower rate. So those rates are still out there and available for
okay,
financial purchase.
awesome. All right, Rocky, I said it would be about 15 minutes. I clearly lied. So it's a bit longer than that. But I thank you so much for doing this with me. I needed that closure. I needed to know what's going on. And I hope that our audience also came out a bit more informed as well.
Well, thank you for the opportunity. Always
Thank you,
great.
Bella.
All right.
Ciao.
Bye.
Bye. Bye.